I want to welcome everybody for coming to today's Lunch and Learn. My name is Beth Graybaugh, and I'm with Veterans in Agriculture. And so today's program was made possible by a grant from the North Central Extension Risk Management and USDA. So if you have a question during the program, just please put it in chat, and then we'll also open up the discussion following today's presentation. So today we have Dwayne Johnson. He's part of Iowa State University, and he provides counseling and financial analysis to small businesses. So welcome, Dwayne.
Yes, thank you, Beth. Yes, I work for Iowa State University Extension and Outreach, and in a unit called Farm, Food, and Enterprise Development. We'll talk a little bit more later about what we do in our unit, but today we're going to talk about creating a business plan. And to start, we'll talk about why you typically are creating a business plan. Oftentimes it is at the request of a lender or of a financer for a new business operation or for an existing operation that is looking to expand, or perhaps someone buying a new business. The significance of a business plan is it serves as a roadmap for the business. So it shows us where we're going and how we plan to get there. And for the lender's purposes, it shows that we've sat down and thought through our business and know exactly what it is that we're getting into and how we're going to execute our plan. Our business plan will identify the key personnel, the owners, the employees, and any advisors. We will document the market data, show that we've thought about the market size, the target market for our business, and we will establish critical milestones along the way. We will need to develop financial projections that are typically for 3 years, and those would be the profit and loss statement, the balance sheet, and cash flow analysis. And this will provide a document of what, who, and how for the financial decision makers. If you go online and you look for business plan outlines or how to do a business plan, you'll find all kinds of different formats and layouts and different ways to do it. So there's many choices. The one we have chosen to use is fairly simple. It's just got the 5 sections that you see in front of you. We take it from a product called Live Plan, which is an online application that works with business plans and projections. We'll talk about that a little bit more later also. But it starts off with an executive summary. The second section is called the opportunity, followed by execution and company and financial plan. And we are going to dive into each of those in more detail, starting with the executive summary. Excuse me. And although the executive summary comes first, we write this section last. The executive summary is going to include information from all the other sections. So first, we're going to go ahead and write the entire business plan, and then we're going to come back and write our executive summary, pulling information out of each of the other sections. And as indicated before, the first section is opportunity. Opportunity is going to be broken down into 3 subcategories: the problem and solution, the target market, and the competition. And we will describe those here in a minute. First one is the problem and the solution. Most new businesses are started to address a problem. The potential business owner has found a need for a service or business or a product, and they believe they can do it better or differently than what's being done presently. So oftentimes it can be a functional problem where there is an existing solution out there, but we believe it's insufficient, and we have a solution that will be better than the existing, something like building a better mousetrap. It might be a financial problem where the existing solution is very expensive or more expensive than we believe it needs to be, and we're offering a less expensive solution. Or it might be a geographic problem where, for example, in my town, there might be no bookstore. And I believe there should be a bookstore. There's no bookstore, so I'm going to open a bookstore in town. Or there's no Italian restaurant nearby, so we're going to open an Italian restaurant. That is how we propose to address the problem. The second piece of the opportunity is to look at the target market. We'll want to try to determine what sort of market size exists. And to do that, we're going to look at market segments. So, for example, one type of market segment could be age group, where my product is geared towards, say, young children, or it might be more geared towards seniors. What age group is most likely to use our product or service? Or we might have a segment that is based on income level. If I'm selling Rolex watches, for example, I would probably be targeting a higher level of income. And thirdly, we have family status. Are we targeting singles? Are we targeting people with teenagers? What are we targeting again there? And location. In the internet age, with Amazon, our location could, in theory, be nationwide or even international. But more likely, if we're starting a small business, what we're targeting is some more specific geographic location. If, for example, I'm opening a barbershop, probably going to have a fairly small geographic market, as most people won't drive a long ways to get there. And also under the opportunity, we're going to look at competition, both direct competition and indirect competition. With direct competition, we are looking at someone who is selling the same product or service as we are. So, for example, again, if we use pizza, if there's a pizza place across town and I'm opening one on this side of town, they're my direct competition. The indirect competition are those businesses who are trying to satisfy the same need that I am, but they're selling a different product. So this would be if there's a Subway in town and I'm opening that pizza restaurant, we're trying to meet the same need, but we're selling different products. So that's indirect competition. In that instance, a grocery store could, in theory, even be indirect competition, as in particular those that sell ready-to-eat meals. So I want to look at our competition, kind of look at what they do well, what they don't do well, what will we do differently, what will we do better. We want to describe all those things. And we also want to show that we've thought about our pricing. Are we going to try to be the low price competitor? Are we just going to fit somewhere in the middle? Maybe we're going to be a top end provider. And there's a reason we have superior quality or superior service or something we're doing differently or better that allows us to price our product differently. Again, we want to be able to show that we've really thought this through. Next then comes the third bullet of our business plan, and that's the execution of the plan. Very first thing we need to think about is marketing and sales. Marketing, of course, meaning how are we going to let people know about our business? Are we going to put a sign up front and wait for the business to kind of gradually trickle in? Are we going to be more aggressive and do radio advertising or maybe a mailer? What are we going to do to get people in the door? What are we going to do to let people know about us? And then our sales strategy is more like once we've got the customers calling us, we've got the customers coming in the door, how are we going to close the sale? Are we going to be more aggressive? Maybe something like a car salesman who will come out and greet each customer and try to make the sale that way. Or maybe more like some of the retailers use, where they basically wait for the customers to just browse and make their selections and come to them. Also under the sales strategy, you need to think about the physical way you're going to close the sale. What sorts of payments are we going to take? Are we going to continue to take checks, or is that obsolete? Will we take some of the newer forms of payment, touchless and Venmo and those sorts of things? How are we going to close the sale physically? We're also going to look at our operations and discuss our operations. what is our location going to be? Are we going to start our business out of our home, or maybe just out of the garage? Or do we need a storefront and maybe a warehouse? What sorts of facilities do we need? Technology, do we need to buy a computer, printer, point of sale terminal? What all do we need from a technology standpoint? And then equipment and tools. Some businesses, particularly in the service industry, won't have a great need here. I think of like an accountant or bookkeeper. Once they have their technology taken care of, they probably have most of their needs covered. Don't need a lot of equipment and tools, but if you're starting a restaurant and you need a refrigerator and you need a freezer, and you need a commercial oven, and then you need the front room things such as tables and chairs and on, you'll want to list these all out and ideally have them priced, at least ballpark priced, so we know what the upfront costs will be. And then we have milestones. Milestones are target dates when we're trying to accomplish a certain task to getting our business open, or for once we have our business up and running. So for example, we might say we want to find a location and sign a lease by the end of May. And then we want to have our marketing materials printed by the end of June. And we want our doors open on the 1st of August. And then metrics are a little different. Metrics look more at the numerical side of things rather than dates. So metrics might be, I might want to make 100 sales in my first year is my target for my sales. Or it might be if I'm a manufacturer and I'm producing an item, I want to keep my my error rate to less than 5%, so I don't have a lot of waste. Various numerical targets. Then my next section of my business plan is going to be about the company. We're going to first of all talk about the ownership and the structure. Who are the owners? Am I the sole owner, or will I have a partner? Will my spouse be a part owner? How am I going to structure the ownership of the company? Structure just refers to, is it going to be a sole proprietorship? Going to be an LLC, subchapter S? What is going to be the legal organization of the company? Most small businesses, of course, start out as sole proprietors, and then they, as they grow and mature, they're likely to eventually switch over to an LLC or maybe a subchapter S down the road somewhere. Company history. If I'm just starting a business, of course, I don't really have a lot to talk about here, but I might be buying an existing business, or I might have an existing business that I'm just looking to expand, and that's the need for my finances. That's the need for the financing, I should say. So I want to describe the company history, and particularly I want to describe the successes we've had. We want to continue to show our lender why we will be successful as we move forward and why this is a good loan for them to make. We want to describe our management team. Again, perhaps I'm the only manager. I'm the sole operator. I run the whole business front to back, and that's the management team. But maybe it's a little bigger business. Either, again, I'm buying an existing business or I'm running a business that's growing. And then I need to describe my management team. And maybe if I have an organizational chart, I want to include that here. Resumes for all the managers, if possible. And then advisors. This can be a key role, especially, again, if this is a startup. Are there people I am relying on for their expertise? They can be professionals, such as my lawyer or my bookkeeper or accountant, or they might be other consultants, such as from the Small Business Development Center or one of the SCORE representatives, which are a couple of really good ways to get free consulting from experienced business people. And then the other category of advisors could be just people I know, neighbors, friends, relatives, people that have experience in business who I can turn to and trust to give me good advice as I open my business and grow my business. And lastly, as far as the 5 sections of the business plan go, is the financial piece. Here's where we want to do our projections. They have to be 3 years at a minimum. Generally, we just stick with 3 years. We want to disclose our key assumptions. What were the things we used? What are the things we relied upon to determine how much revenue we would have, what our expenses were going to be, that sort of thing. We'll look at our revenue and expenses by month, and we'll want to do monthly projections for the first year. After the first year, it's optional. You can either continue to do monthly projections for the full 3-year projection period, or you can start to just do annual projections for year 2 and 3. But for that first year especially, we want to see month to month, partly because we want to see how the cash is, that there's going to be cash available. What can sometimes happen in a startup is, it's going to be slower to begin, and then it's going to build over time. But we've got to be careful and make sure that there's cash available to run the business as going through those growing pains. Then, of course, we're going to come to a net profit or loss. And we're going to want to, if possible, benchmark our results against other similar companies. We're going to talk more about that a few slides down the road here. Continuing to talk about the financial plan, we'll talk about what's included in the financial plan and get a little bit more specific. For statements, we're going to have a projected profit and loss, of course, also known as the income statement. We're going to have the balance sheet, and we're going to have the cash flow statements. And we're also going to show, for our financing, we're going to show our sources of funds. Where are we getting the money to start this business? And then the uses of funds, which of course is how we're going to use the funds that we have brought in. For income statement projections, just to talk a little about what each of these statements are. The income statement looks at financial performance over a specific time period. Usually we'll look at results month by month, or we'll look at them as an annual basis. For an ag type business, oftentimes the annual period makes the most sense because we're not like a retail business where we're seeing revenue monthly. Oftentimes in an ag business, the revenue comes in chunks, and it comes when we sell a commodity or we take livestock to market or those sorts of things. So our revenue is not even from month to month. So we'll want to look at our annual results typically, but we might want to use our monthly results to look at specific expenses or specific accounts. So we might say, look at how this particular account, what did we spend on that last month? And are we up or down, or which direction are we headed there? And does it make sense? Or the other thing is to look at the previous year projections. Once we have a year of experience behind us, what did we spend on utilities last May? What did we spend on utilities this May? And if there's a big difference, can we explain why there's a big difference? Just a good way to track expenses that way. Looking at the balance sheet will not look at our results over a period of time, but it looks at our financial position as of a specific date. And then what we call it a balance sheet, of course, because we must be in balance on both sides of our equation. The assets has to equal the liabilities plus the equity, or sometimes it's a little easier to think about it as the assets minus the liabilities equals the equity. Sometimes a simple way to think of it is assets is what we own, liabilities are what we owe, and equity is basically what's left over. And a little bit more about the balance sheet, just to kind of break it down a little bit. We'll take assets and we will split that out into current assets and long-term assets. Current assets being basically things that can be turned into cash within 30 days. In this case, that would be cash, of course, or our accounts receivable. Generally speaking, our receivables will be due within 30 days. And it could even be things like short-term investments like CDs or something like that, considered a current asset. Long-term asset would be things we're going to hold for a long period of time, such as real estate or equipment. Liabilities then, same categories, current liabilities, long-term liabilities. Current liabilities, accounts payable, wages payable, things that we're going to have to pay out within 30 days. Accounts payable basically being what we owe to our vendors, our suppliers. Long-term liabilities are the best example there. It would just be loans payable. And then equity, typically, all of these things, of course, we're greatly simplifying, but these are the most common types of amounts you'll see in the balance sheet. But equity, typically, you'll start out with owner contributions, which, of course, is the cash that you are putting into the business as you get it started. And then perhaps as the business goes along, you may need to inject more cash, depending on how things are going. Ideally, you will eventually begin to draw out and be able to pay some of your personal expenses with your business profits. But then also retained earnings. Over time, as the business grows and matures and becomes more successful, the idea is that you will start to have more profit than the amount that you're needing to take out of the business. So if you're needing to take out $2,000 a month to pay for personal expenses, ideally, once the business is up and running for a period of time, you will be creating more revenue than that, creating more profit than that, and you'll begin to build retained earnings. Then on to the cash flow statement. The cash flow statement, like the income statement, looks at performance over a period of time. It compares the beginning cash balance with the ending cash balance. And most often we're looking at this annually. We don't usually have a whole lot of need to look at this monthly, unless there's a concern about our cash balance. But we'll look at summarize. What this does is summarize the activity that has occurred during the period. We start with our beginning cash, a whole bunch of things happen in the middle, and then we have our ending cash balance, and then we're gonna look at what happened in the middle. So the cash in would be things like, of course, sales revenue. If we happen to take a loan during the period, that would be cash coming in. And again, the owner contributions we might be making during a given period. And then the cash out, vendor payments, employee wages. We probably have some loan payments. And then we might be taking out an owner distribution depending on our need. Then the sources and uses of funds. The bank really likes to see this. Again, it's another one of those things that just kind of shows that we have really thought through what we're doing. We know where the money is going to come from. We know what we're going to use it on, and kind of how we came to ask for what we're asking the bank for. In this really simple example in front of me here, we're asking for $80,000. I should point out that this sources and uses, I know this is kind of small, hopefully you can read it, but the sources and uses document also is one that has to be in balance. So you can see that both sides total to $100,000. We're putting in $20,000 of our own money. Typically, that will be a requirement of the business loan is usually 20 to 25% owner contribution. And then the loan is broken down between the SBA bank, but we're asking for $80,000. And the uses side then is our chance to show the bank how we came up with the $80,000. Why is it that we need $80,000? Well, here's how we're going to spend our money. We're going to spend it on real estate. And this is a very, very simplistic example that this could potentially be like opening a little restaurant. Real estate of $65,000. Building improvements, which is like remodeling, $12,000. Kitchen equipment, $15,000. A sign out front for $1,500. And working capital of $6,500. And in a situation like this, we will want to make sure that there's sufficient working capital. We know, again, startup is going to be slow. The funds typically don't begin to flow terribly quickly right away. We're going to have some supplies we need. We're going to have some other things, maybe some little things we didn't think of. We're going to have to spend our money on. So we want to make sure we have some working capital up front. Also, for things like kitchen equipment or the building improvements, those sorts of things, ideally we'll give as much detail as possible. Here I've just shown summarized numbers, 15,000 for kitchen equipment, for example. But what we would want to do on a separate document or separate page, or maybe just down below on this page, would be to show item by item what we're spending that $15,000 on. Again, back to the refrigerator and the freezer and the oven and the other equipment that we need for our kitchen. Then after all that, we have an appendix, and we just want to have a place where we can attach all the pertinent documents, again, that the banker is going to want to see. If we have resumes, we would attach those here. If we have pictures, maybe we have a certain product we're making and we've got a prototype, we want to take a picture of that and attach it here. Maybe we want to take a picture of the storefront that we're looking at, that we're trying to either purchase or lease. Take a picture of that and put it here. If our business requires any permitting or licenses, we'd want to make copies of those and have them here. Other legal documents, such as maybe we've done a DBA, doing business as, so we've reserved the name, or maybe we do have an LLC or a subchapter S, and we'd want to include those documents here showing our legal status. And sometimes you'll get a letter of reference. It's nice to have if you get them. Maybe your banker gives you, or I'm sorry, your real estate agent gives you a letter of reference. A local business person gives you a letter of reference. Someone just to vouch for you or to support you in your cause. Maybe a supplier. Some resources for business planning. I think I mentioned earlier the Live Plan software. That's what we currently use. It combines both the outline for the business plan to kind of step you through the business plan, along with the ability to do the financial projections. So it works pretty slick. There's another, University of Minnesota has something they call Ag Plan at agplan.umn.edu, where they have a variety of business plan assistance. They have a series of short videos you can look at that talk about the different sections of the business plan. They have some templates for business plans and spreadsheets to do the projections. A little more difficult than having the actual software that leads you through it. They do have the spreadsheets. You kind of need to know your way around a spreadsheet, but it's a possibility to go there. And of course, that's free. I should mention that the Live Plan software has a small cost involved, currently at $10 a month. Previously, it was $20 a month, and I imagine at some point I'll go back to that. But right now, it's $10 a month. Another resource is a business plan outline that I'm going to show you here in a minute. It involves those same 5 steps that we've just walked through, and it just kind of breaks it down into a simple step-by-step creation of that 5-point outline, or that 5-point business plan. And then I say samples are available. There are business plan samples all over the place. Again, you can get them online. We have something we could send to you. Live Plan has, if you should decide to use Live Plan, they have many sample business plans there. Ag Plan at UMN, I think might just have one, but there's one there. It really just helps as you're getting ready to do a business plan to look through at least a couple of others. They may not have all the same sections that you have, or they may be organized differently, but most of the same information should be there. And I encourage you to use those samples to help you. This is the business plan outline, and we are going to make this available after the presentation today. I won't spend a lot of time looking at that right now because it's hard to read, but we will have that. And then to talk just a little bit about benchmarking. Benchmarking is comparing your projections to results achieved by similar companies. So if we're putting together projections for our new business, rather than just kind of pulling the numbers out of thin air, it would help if we had something to base those on. So if we could look at how other businesses are doing in this line of work, that would help us develop our projections. And some resources for that, small business development centers. If you're not familiar with those, there's, I believe, 15 locations around the state of Iowa, and they are free, offer free consultation. I believe they have access to something called BizMiner. I'll show you a BizMiner report in a minute here. which is something we use for benchmarking, and makes it pretty easy to kind of get an idea of how your business might perform. You can reach the Small Business Development Centers at iowasbdc.org. University of Minnesota, again, has something for benchmarking. It's called finbin.umn.edu. The interesting thing about that is it has data for many of the surrounding states, but it does not have Iowa data. Regardless, I think it's still valuable because I think that the data is similar, but just know that Iowa is shown there. And then there's the Economic Research Service for the USDA. They have some benchmarking data. It's a little more digging involved there. You kind of find your way through their website. And lastly, probably the easiest way to get benchmarking data might be your lender. So I would consider asking your lender. Many of those do also have BizMiner as well, as I understand it. And as we start to look at benchmarking, we're going to need to find the NAICS code of our business. This is actually the North American Industry Classification System, but everyone just calls it NAICS code. That's NAICS, and you can just go to NAICS.com. And I've given an example here of a search at NAICS.com, where I just went and put in the input in the search term, cattle feedlots, and then it returns a list of potential NAICS codes that I might want to look at. I've just taken the top part of the list here. And you can see that, of course, the first one that came in was cattle feedlots, which is code 112112. So then I go to my BizMiner web application, and this, by the way, is a fairly pricey application. So that's why I'm not suggesting anyone go purchase it. Instead, ask your SBDC or ask your lender if they have access to it. And then you can see NAICS 112112 for the state of Iowa, with businesses with revenue from $500,000 to $1 million. These are the averages over the last few years. Average revenue, cost of sales, and so on down the line. Valuable information, but even more valuable is the next page, which is the exact same chart, but now it's in percentages. And in this way, I can look at how my percentages stack up. Is my gross margin similar to the 72.5 that they're suggesting here? If my gross margin is coming in at 80%, I probably need to understand why that is, and if it in fact is achievable, and be able to explain that to my banker, because he's probably going to ask me about it. Anyway, good way to do benchmarking with BizMiner. A few final thoughts. Try your best to be realistic with projections. It's better to overperform than underperform. If we are realistic and we target a realistic bottom line in the first year, and we achieve a better bottom line, everybody's happy. If we start out targeting fantastic results and we achieve good results, we might still be disappointed because we didn't hit our targets. So better to be realistic with the projections. If possible, compare the benchmarks. And then lastly, you might want to go back and update your projections after a period of time. This is where we tend to get involved in our business. And once we've done that business plan, we kind of forget about it. But especially for the projections, it's probably a good idea at maybe 3 to 6 months or somewhere down the line to go back, look at our projections and see how things are going, and go ahead and update those to how things are actually playing out at this point in time. So farm, food, and enterprise development, we do offer a variety of things. I'm going to run through those real quick. First of all, USDA programs often will require a third-party feasibility study. They require a third party to look at your proposed business and sign off on the feasibility of that business. It's a fairly involved process, but we can offer those to businesses in the area. We can also do certified business appraisals. There are quite a few people that you can find to do a business appraisal. Harder to find someone who can do a certified business appraisal, which is needed in certain situations where there's perhaps a a business is changing hands or some other reason that often involves legal stuff. Both those first two are very fairly involved, time consuming, and so we do charge fees for those. The last three, not necessarily. We may charge a fee if we think it's going to be quite involved. Otherwise, a lot of times we will do these free of charge. That's a feasibility snapshot. Same kind of thing as a feasibility study, but it's just not as in-depth. Business plan assistance, we can provide some assistance with business plans. We don't necessarily write a business plan, but we can help answer questions, point you in the right direction, look it over and review it for you if you need someone to just review. Or we can also do a market analysis where we look at a certain geography and let you know about what we find there for competition and what the market looks like in that area. I believe that is it for today. I'll be happy to entertain any questions, and there is my email and contact information.
Well, thank you very much, Dwayne, for all of that information. And it really, the more detailed that you can be, or how do I want to say this? How thoroughly you have thought about all of those different components is really going to make a difference when you go to that lender.
Right. Yeah, the more you can, like I say, a lot of it is really putting your best foot forward, I guess, and you want to look as professional and as prepared as you can when you take that information to a lender. So yeah, the more detailed you can be, the more thorough you can be, the better off you're going to be. Yeah. So
will there ever be a time where the lender will say, because you talked about, that you're going to want to look at these numbers, periodically. Is there ever a time where the lender may ask you for an updated plan, or do they periodically, or are they going to want to check it? Are they going to want more information, or what does that look like after making the loan?
As I have not ever been in the shoes of a lender, but as I understand it, I don't know that they would necessarily want to see the business plan again, but they may ask to see your financial results. Obviously, if there's become a problem, they're be very likely to want to see your financial results. But they may ask for annual financial statements, that sort of thing, just to kind of keep tabs on how things are going for you.
Yeah, and I would imagine also as the economic climate changes, you'll want to make sure that you're being realistic and projecting how things could all of a sudden be good or bad. Yeah,
absolutely. I think we've all seen that. That's the thing with projections, right? And that's why it is not a bad idea to go back and look at things. 6 months from now, who knows what's transpired in the meantime, and things could really look different. So,
well, very good. We have not gotten any other questions from anyone. So with that, I'll thank you again for joining us and providing all of this great information is what we need to consider as we're building that business plan.
Yeah, and do we want to mention at all where this will be available?
Pardon me?
Do we want to mention where this outline would be available, or the slideshow, or
yeah, so we'll be posting this presentation online, and we'll provide a link to where we can obtain it. Okay. And I will also include all of that information when I send out a newsletter with all these links.
All right, thanks, Beth.
All right, with that, I thank you everybody for joining us. And again, thank you for Dwayne for providing us such great information.
All right, glad to do it.
All right, thank you.